Are there structural reasons to make the argument the rates can be higher for longer, than we have truly broken out of that pre-pandemic, post-GFC regime that we were in for the best part of a decade?
Oh, absolutely. And you've heard me say this. This is a different global economy. This is no longer an economy where aggregate demand is deficient. This is an economy where there's insufficient aggregate supply. We feel it in the labor market. We feel it in terms of the supply chains being rewired. We feel it in terms of the energy transition, and the list goes on. So yes, this is structurally a very different global economy. And that's a problem, because that framework is directed at an economy with insufficient aggregate demand. The inflation target, as you've heard me say, may be too low for this world. So yes, there's lots of reasons to argue that this is a fundamentally different economy, but it raises critical aspects in terms of monetary policy.
Well, let's talk about the monetary policy call for September, which sounds boring compared to what we just discussed. Is it too early to make a call as to what they may or may not do a month from now, given we still have one more CPI report and another payrolls report around the corner?
I think it is. They've told us over and over again that they are highly data dependent, and we have to respect that. So we have to see what the jobs report and what the CPI inflation report is going to say.
CPI, September 13th, for those following. Early September, you get the payrolls report. Mohamed, if we can finish on the market, I think we should. Equities today are down about 0.5%, off the highs of July by about 5% on the S&P 500, on the Nasdaq by 8%. High yield spread still incredibly tight. What do you think explains that, Mohamed, given the challenge we see developing in the bond market, with rates of 5% at the front end, close to 450 down the longer end of the curve just yesterday? Isn't that a challenge to this risk appetite in equities, in credit?
It is a challenge, but I think we have to put it into context, John. When we were talking back in July, there was a sense of the market overdoing the romance with the soft landing narrative. And it went too far, both on the bond side and on the equity side. So I see this as a give back after a month of excessive romance with the soft landing. Step back, John, if I had told you in the beginning of the year that the S&P would be up 14%, that the Nasdaq would be up 27%, I think you would have said most investors would have taken that. So, it's important to keep a perspective on this. I think what you're seeing here is people are realizing that it's not going to be as simple as the soft landing narrative that the market fell in love with back in July.